Why this topic matters right now is simple but powerful. Kalshi has opened 15-minute commodity markets, offering rapid exposure to moves in gold, oil, copper, and corn. In a world of headlines and volatile price swings, traders crave intraday hedges and quick liquidity. These short-window contracts let consumers speculate or hedge within a single trading day or even a few hours. The timing could reshape risk management for producers, funds, and retail traders alike, turning minutes into opportunities. As markets churn, the pace of information flow accelerates, and decisions must be made with speed and discipline. Investors watch futures curves, liquidity depth, and exchange rules. Kalshi has rolled out new markets with 15-minute expiries on select commodities. Instead of a daily settle, traders choose a window like 12 p.m. to 12:15 p.m. or 2:45 p.m. to 3:00 p.m. If the price hits your chosen target or simply moves enough within that window, you receive a payout based on the contract's terms. The idea mirrors a stock option, but works on a clean prediction basis with cash-settled outcomes rather than shares. These are not spot trades. They are binary or multi-level outcomes tied to intraday price behavior, trading alongside standard futures. Liquidity will depend on participation and market makers. To understand this move, you need a quick history of Kalshi and intraday risk tools. Kalshi began as a regulated exchange for binary events, growing from gamble-like bets to structured financial products. Before 15-minute markets, participants traded daily or weekly contracts linked to price levels, weather outcomes, or events. Traders appreciated transparency, fair settlement, and regulated counterparty risk. The regulatory framework by the CFTC shaped early growth, while competitors paused or waited. Now, the platform leverages scalable technology and clear pricing to embed intraday cadence into its product line, aligning with intense pressure from banks, asset managers, and retail networks. Markets are responding with growing liquidity in the new windows and higher volumes around key moments. Traders report tighter bid-ask spreads, more rapid price discovery during the 15-minute periods, and a broader mix of participants. For risk managers, intraday markets offer a new hedge sleeve against sudden moves in crude, gold, or copper. Some funds have started allocating a small sleeve to test sensitivity, while day traders flock to the volatility spark. Exchanges highlight rising data feeds, API integrations, and improved market depth as proof of adoption accelerating this quarter. Volatility metrics show intraday swings intensifying compared with full-day horizons. Multiple players feel the ripple effect. Producers facing price risk may hedge with shorter horizons, while hedged funds adjust models to reflect faster outcomes. Asset managers reprice risk premia for energy metals and agriculture baskets. Retail investors gain access to a new form of exposure without needing futures accounts, but they also face a steeper learning curve and heightened risk awareness. Banks and brokers roll out API support and educational content, expanding onboarding for intraday strategies. Exchanges and market makers profit from tighter spreads and more fee streams. Startups building analytics and alert tools discover a market hungry for data and decision speed. Global inflation remains a driver for commodity volatility, and monetary policy anticipation feeds intraday moves. Kalshi's new markets arrive as traders seek flexible hedges amid energy supply concerns, weather swings, and agricultural seasonality. Geopolitical tensions, sanctions, and trade tensions add to price discovery noise, while dollar strength or weakness shifts currency exposure across traded windows. Investors monitor inventory reports, supply disruptions, and refinery outages that produce quick, two-way price reversals. The intraday structure can amplify or dampen reaction to political headlines, depending on liquidity and confidence in market makers. Policy shifts, including rate surprises, echo through futures curves and option models. Smart money is testing the water with cautious steps. Institutions deploy risk controls, monitor intraday liquidity, and use algorithms to scout fair values by window. Some pension funds and endowments allocate a small portion to intraday commodity bets to diversify sources of alpha, while others remain on the sidelines until margins and settlement reliability firm up. Retail desks issue education guides, risk disclosures, and starter templates. Overall, the mood is curious rather than conviction as players measure correlation, funding costs, and fee structures across Kalshi's platform. Hedge funds test scalping scripts, while asset allocators compare realized volatility against implied signals. Like any rapid expansion, risks mount. Intraday markets can exaggerate price moves, triggering whipsaws that hurt small traders and misprice risk for big players. There is potential for liquidity to dry up during off hours or sharp spikes in margin requirements, forcing forced liquidations. The complexity of calibrating probability models for 15-minute windows invites systematic errors. Regulatory scrutiny could tighten controls or raise trading costs. Market manipulation risks exist if participants attempt spoofing or cornering within tight windows. Finally, the novelty may fade if liquidity fails to attract durable participants, leaving fragile markets exposed to shocks. Investors demand transparency and robust risk checks. Retail traders considering these markets should start with education and small allocations. Use practice accounts or paper trades first to learn window sizing, payout mechanics, and fee structures. Focus on risk controls such as stop losses by window, position sizing, and diversification across several commodities. Track real-time news and inventory data to anticipate intraday bias. Compare Kalshi's quotes with traditional futures spreads and monitor liquidity depth during key sessions. Maintain a simple rule set. Only trade what you understand, avoid over-leveraging, and document your outcomes to learn a disciplined approach over time. Keep records, review trades weekly, and adjust risk parameters as you gain experience. Looking ahead, Kalshi's 15-minute commodity markets could redefine how we think about timing risk and price discovery. If liquidity sustains, the intraday window may become a standard tool in hedging and expressing views on energy, metals, and agricultural markets. Traders could shift some analytical focus from daily close levels to minute-by-minute signals, integrating data feeds, order book depth, and volatility regimes. Yet adoption will hinge on reliability, clear settlement, and sensible fees that align incentives for both large institutions and individual participants. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.